We live in an era of information overload. Answers to most of the world's questions lie at our fingertips, but many mysteries remain unsolved. For example, are we alone in the universe? Does God exist? Or the big one, why did Liz Truss think her mini budget was a good idea?
I am resigning.
But if you're an investor, there's a bigger existential question. Can you spot the bottom of a bear market?
In this film, we're examining how the right combination of unemployment, inflation, and liquidity can work together and create the right conditions for the market to bottom out.
It can happen when there's the right combination of unemployment, inflation, and liquidity. We're going to use those metrics to stress test this year, 2022. Could this be as bad as it gets? Has the stock market finished falling, or might there still be worse to come? Keep watching to see what we found. Now hold up, before we go any further, quick reminder, we produce video explainers here at Capital.com on all types of subjects related to the markets. You can click on the link to watch our recent explainer on interest rates and how high they can go. First, let's remind ourselves what timing the bottom of the market even means. It's an investment strategy that involves gauging the stock market and buying undervalued assets in the hope that they'll bounce back. For the purpose of this film, a bear market is when the market falls more than 20% in value. That's happened 7 times since 1970. Timing in life is everything, right? But when it comes to investing, maybe not. There's a wise old market saying that goes like this: time in the market is better than trying to time the market. Let's take an example. If you'd put $10,000 into the market at the turn of the millennium and just left it alone, today it'd be worth $26,000. Now, if you'd bailed out before the first bear market dip, you would have made almost $500. But if you'd magically cashed out and bought back in after every dip, you would have made 804%, or $236,000. Timing the dip can therefore potentially generate bigger profits than the slow and steady approach. But if you leave your money on the sidelines, waiting for the end of the dip, you might miss returns elsewhere in the market. And if you mistime it, the value of your shares could fall through the floor.
Throughout the film, we're going to be hearing from Eric Lonergan, macro hedge fund manager, author, and writer. As far as he's concerned, timing the dip is extremely difficult. But once you're at the bottom, his advice is simple.
If you look at the S&P 500 and you look at the instances of recessions over the last 100 or so years, typically recessions have been a very good time to buy the stock market.
To understand bear markets, you need to understand the most important fiscal institution on the planet, the Federal Reserve. The Federal Reserve, or the Fed, is America's central bank and has the power to increase or decrease interest rates. Interest rates determine the cost of mortgages, borrowing, government debt, basically everything. If the Fed cuts rates, that can boost growth, and if they hike them to cool the markets, it can tip an economy into recession. Just after the Fed cut rates here, here, and here, the stock market started rising. To anticipate when the Fed might be about to cut interest rates, you need to keep your eyes on 2 metrics: unemployment and inflation. First up, unemployment. During recessions or market dips, unemployment usually rises.
This graph shows unemployment spikes over the past 50 years. They've happened near the bottom of the bear market on 5 occasions. But unemployment spiked in 1992, and there was no market dip. And the S&P 500 climbed off the bottom in 1987 when unemployment was low.
But high unemployment doesn't mean the Fed is about to act, because the Fed can't afford to ignore inflation. If you cut interest rates when inflation is rising, that might just make the whole thing worse. Unemployment spikes can push down inflation, as fewer people have money to put into the economy, and that's the combination we're looking for. It's happened on these 4 occasions. and each time it was followed by a market rally. And that's because it created the right economic environment for the Fed to loosen monetary policy.
When you have an inflation problem, what they do is they raise interest rates until unemployment goes up, and unemployment going up causes wage growth to decline, and wages are the biggest cost in a modern economy, and in order to get wage costs down, then you get inflation down. Once that process is underway, they can then reduce interest rates.
Low interest rates mean consumers are spending less money servicing their debt, which means they have more to put into the economy. But interest rates alone still can't tell you everything you need to know. That's because the Fed isn't a one-trick pony, and the Fed knows that cash is king. If there's one thing the American stock market loves, it's liquidity. Financial liquidity describes how easily companies can turn their assets into cash. If the Fed gets worried there isn't enough money sloshing around, it can do something drastic called quantitative easing, or QE. It's when the Fed steps in and buys a significant amount of government bonds. In other words, it's when they start printing money.
Kiko, where'd you get your bond?
In the financial crisis of 2008, the phrase QE moved from the financial pages to the front pages, as the Fed used taxpayer money to buy shares in privately owned companies. After the collapse of Lehman Brothers, the Fed started buying up almost $2 trillion in mortgage securities and agency debt. It was drastic. It was unprecedented, but it worked. As money started plowing through the American economy, the S&P 500 started a 127-month-long bull run, the longest in history. The world breathed a sigh of relief. A crisis had been averted. Banks were regulated and borrowing was restricted. QE became the bandage that fixed, at least temporarily, the problems of many economies. And then, over a decade later, this happened.
First, the unfolding coronavirus emergency.
The breaking news, stay at home.
A ninth person has tested positive for coronavirus in the UK.
The COVID shock of 2020 meant governments told people to stay home to stay alive. And that meant they had to pay a lot of people a lot of money not to work. In March 2020, almost $2 trillion was pumped into the American economy in the form of economic impact payments of $1,400 per person. Personal savings rates hit 12.4%, higher than any point since the early 80s, and all that money needed to go somewhere. And how did the stock market react? It couldn't have been happier. While lockdowns are crashing the real economy, the massive liquidity boost pushed the stock market to record highs. The cash injection put a rocket under one sector in particular. Here again is our liquidity line. Now, let's add on the market cap of US megatech, stocks like Apple, Amazon, and Netflix. The government stimulus package caused the total value of big tech stocks to almost double.
However, while QE might have boosted American markets, it didn't have the same impact around the world.
So if you say it's QE, well then why didn't QE in Japan cause the stock market to go up? The main driver of the S&P has been US profits growth. Just look at the profits that have been generated by US companies. They've been extraordinary.
Big government stimulus packages don't happen very often. But if the Fed starts printing money, investors watching the S&P 500 need to sit up and take notice. "2022 hasn't exactly been a bastion of calm.
And now, second big reason for inflation is Vladimir Putin.
The economy and the volatile stock market.
I cannot deliver the mandate.
But have we found the bottom of the bad news barrel?
A pandemic just completely distorts all of the economic process, and it's just going to take some time before we really have an understanding of what the actual economy looks like.
Let's look back on our metrics of low inflation, unemployment spikes, and government stimulus packages to see where we are. We know that big spikes in unemployment can happen just before the market starts climbing out of the dip. But unemployment levels in November 2022 are at historic lows of 3.5%, equal to July's 29-month low. We also know that low levels of inflation can spark the Fed into action.
Inflation hitting its highest level in, get this, 41 years.
But in 2022, inflation is at other ideas.
US inflation hit 8.2% in October. The last year it hit that level was 1982. The Fed knows that cutting interest rates now could risk pushing inflation even higher.
Lastly, liquidity. We know that stocks and shares love splashing around in pools of cash. Since the beginning of 2022, liquidity in the US economy has fallen by 22%. It's the biggest year-on-year fall since 2010. In fact, the Fed has been so worried about the economy that it's been busy reducing its holdings of treasuries and mortgage-backed securities. In other words, reducing the amount of liquidity.
I'm afraid on a 6 to 9 to 12 month view, I think things could get quite unpleasant in the economy. So I think we are likely to be going into a recession if we're not already in one. And the recession could be quite deep and very damaging, unfortunately.
The end of 2022 hasn't met our market bottom metrics for unemployment, liquidity, and inflation. But just as the COVID shock gave the stock market an unexpected boost in 2020, there could still be a surprise in store for 2023. Thanks so much for watching. Remember that the price of stocks and shares may vary depending on changing market conditions. You can read more of our analysis by clicking on the links in the description below. And don't forget to subscribe to stay alerted to our regular chart analysis videos and other explainers on big financial topics of the day. See you next time.